Okay, welcome everybody. Thank you so much for attending this home buying webinar. I am super excited to be presenting this and also to be doing this with you, Britt. This is Britt Alexander with 8Z Mortgage. Welcome to the show here, Britt.
Thank you for having me. Happy to join.
Absolutely. For all those who have joined, obviously we are going to be getting into what it looks like buying in Denver now. And we've had a crazy year in 2022, really on both sides of the spectrum here, it feels like. And, I think a lot of people are just kind of asking a lot of really good questions on what does it take to actually buy a home in Denver these days? Is it a good time to buy? What should we be expecting? What are some of the pitfalls that we could avoid? Things like that. And so we're going to be covering all of that in this webinar. We're super excited to be bringing this to you. And so with that, let's get right into it. So yeah, buying in Denver, we're going to cover a lot of different topics here and just make sure that you become that savvy home buyer that can win in this market and whatever it ends up changing to as we go forward. And so, like I said, I'm Jacob Stark. I'm a realtor here with 8Z Real Estate. 8Z is named such because every single zip code in Colorado starts with an 8. So we are a very specific boutique brokerage here. And we're actually pound for pound. There is no better brokerage out there in Colorado when you look at our stats with our realtors. So we do a lot of great things. And one of the smart things that we do is we actually have affiliates with 8Z Mortgage, with 8Z Rentals, and a few other. We have title, insurance, and what's so great about that is obviously we can make sure that we are providing the best service in all of those different areas. Britt Alexander has agreed to join me on this webinar and help me host this. And so, Britt, can you tell us a little bit more from the 8Z Mortgage side, how you guys approach all of this?
Absolutely. 8Z Mortgage is under the 8Z umbrella, and we work alongside with 8Z Real Estate to help clients be as competitive as possible, to have a plethora of options available to them. We work as a brokerage, which means that we are not only limited to one select group of products. We have multiple investors that we can help shop and compare and make sure that we find you the best product and best rate for your situation, which is really neat.
Yeah, absolutely. Yeah, and I know from speaking with several clients that have already worked with you and everything, they speak very highly of not just your expertise, but yeah, your ability to not just say, well, you have to use, this certain product, and that's all I have available. The fact that you can take your expertise to that next level is I know not just appreciated, but it's really valuable to clients out there.
Thank you. Yeah, it's one of the best parts about the setup of 8Z Mortgage is that I get to work for the client. So that is where I feel like we team up really well from the real estate and the mortgage side, is that we're a team on the back end helping, whether it be a first-time home buyer or a repeat home buyer, achieve those goals and be able to have that access to multiple options instead of just, oh, here's the only option that you have available. You have a one-stop shop with multiple options available, including title and all the other affiliates, like you said.
Yeah, and I am getting my do not disturb doesn't seem to be working here, so I am going to try to get that back on here. Okay. Yeah, so and with the 8Z brokerage side of things on the real estate side, what's so great here is we bring a modern approach to all of this. And I don't know that we'll have time to go into every facet of what we can do here, but we bring a modern approach to this, meaning that we're looking at what does reality look like today. If cash buyers are winning the day, then we need to help make more people cash buyers, even if they don't have the cash. And or if we need to help sellers, be able to buy that next home before they sell the current home. There's lots of different things that we bring into that modern approach. And then just the process as well. You know, we like to sit down as the realtors here at 8Z. We like to sit down with folks, have a consultation, really speak through what are the goals, what are the timelines, all of that good stuff. Partner with great folks and experts like Britt, and just make sure that we're giving you the full team approach here. That really, at the end of the day, is going to help you be successful in buying that next home. So, Britt, anything else to add at this point, or are we ready to jump in?
I think we're ready to jump in.
Awesome. Let's do it. So, our agenda today, we want to talk a little bit about the market. There's a million things that we could jump into there, and we can't get into every single part of it, but we'll hit the high notes there. And then from there, talk about what do you need as far as a team of advisors when you're buying a home. I think most people, Britt, they probably just think like, well, I just need an agent and, I go from there, maybe a lender or whatever. But you really are kind of building a team of advisors around you. And the better that they work together and understand what you're trying to do, the better off you are. So we'll jump into a little bit of that. We want to talk about some of the biggest pitfalls that exist out there, and we won't be able to cover every single one, but again, we'll cover some of those. And the point there is not to cover every single pitfall, but to tell you that they are out there, they exist, and there's even more. And that really brings the importance of having that team around you, to a head there. You've got to have that team that understands what those are, what to look for, and what the signs are of actually seeing some of those. So. And then Britt, obviously you're going to be jumping into what some of the financing options are, explain a little bit around that, what we have available there. And then we'll round this out with just starting to put together a home buying plan. We're not going to be able to cover all of the home buying, planning here on this webinar, but again, let's give you a little bit of taste of what it is, of what it's like to work with us. And if things look interesting, we can always set up a consultation after. And if not, I guarantee you're going to walk away with some really good information that'll at least help you with the next steps. So, is now a good or a bad time to buy a home? And that's such a big question. There's so much baked into that. And I think what a lot of people are asking there is, if I buy a home today, is it going to be worth more tomorrow? Right. I think a lot of people are just kind of, asking themselves, is now the right time to buy? Are prices going to be going higher or lower from here? And those are really great questions to ask. But the thing that we've got to take a step back and look at is what is your timeline? What is your kind of ownership horizon here for a home? Are you looking to buy and sell within a year? Well, then the price and all that becomes a whole lot more important. Now, hopefully that's not the case, because for the most part, on average, people are going to stay in their home anywhere from 5 to 10 years. I think the average is somewhere around 7 to 8 years these days. And so that gives you obviously time to not only pay down mortgage and gain more equity that way, but your home appreciates as well. And so when we talk about a good or a bad time to buy a home, I just saw a Instagram post lately, and it said, it's not really timing the market, it's having time in the market. So meaning you buy now and you have more time owning the home versus trying to time the exact moment when to buy. So then let's go a bit beyond just like is it going to be worth more tomorrow than it is today? Well, a lot of that has to do with kind of what we call the market, the market triangle here, and what the housing market here really looks at: 3 things: jobs, inventory, and interest rates. And so if we jump into that now, unemployment has been incredibly low for some time now. Here in Colorado, it's currently at 3.6%. Now, obviously, a lot of folks are asking, well, with the Fed trying to curb inflation and they're increasing interest rates, things like that, is that going to affect the job market? It probably will to some extent, right? But here in Colorado, we've got a very strong job market. Will unemployment, the unemployment rate go up? It's completely possible, right? That is completely possible. But neither Britt nor I have a actual crystal ball here, so we can't really say. But right now, things look really strong. And I saw a stat the other day, Britt, I don't know if you've seen something like this, but it said something to the effect of right now, I think there's 2 jobs for every person looking. for every one
Yeah,
person
I heard
working.
that too.
Yeah.
Yeah.
And so, I mean, it's just an incredibly strong job market. And so, I mean, obviously jobs pay wages and wages pay mortgages. And so this is why it's such a big, important factor on the housing market here. Next one is inventory. And this is one that has been high on everybody's mind here for some time now, right? So you can see from this chart here, I actually went all the way back to 2010 when inventory was a lot higher. We're actually measuring inventory by number of months. So you can see back here, 2010, 2011, we got up to about 9 months of inventory. And what that means is if nothing else got added to the market, no new listings, it would take 9 months for us to sell off all the current inventory. Well, that was back in 2011. We are currently sitting just under 2 months of inventory, and it's been like that for some time now. And in fact, in the spring, we're starting to measure it in weeks. Britt, I'm sure you felt the pressure on that one as far as trying to get closings done in record time, right?
Absolutely. And I think that's where the expertise and knowledge of 8Z came into play, especially back in the spring before the interest rate hikes. We saw 8Z agents getting clients under contract more often than some of the other competing brokers because of the expertise, because of their knowledge on how to write a contract. And that goes back to that advisor piece that you were chatting about in markets like this, where we have a market that's under 6 months, which is not technically considered a balanced market. You've got to have the experts and the advisors at your fingertips that know how to win offers in that specific market.
Yeah, absolutely. Yeah, and I mean, the inventory, people have been hearing on the news, well, inventory's doubled or it's gone up, this very high percentage since the spring, which is all very true. But when you're dealing with, literally weeks of inventory and have only improved to, just about 2 months of inventory, that does not mean that there's enough inventory, going around. And so as we are coming up on the spring market in 2023, we'll see what happens there. A lot of folks are kind of predicting that we're going to see another eventful spring. We'll see what comes to fruition there. But right now, with Colorado having a strong job market, still having net positive migration of people moving here, and limited inventory, those are some big points that are going to try to keep the pricing at least where it is. You may see that move a little bit down depending on what we see with interest rates and everything. But with a hot job market and very little inventory, there's just not a lot of room for prices to go down. But that brings us to one of the most important factors, at least right now, Britt, which is more in your expertise here, but interest rates. I mean, we have seen a huge fluctuation in interest rates this year, going from, I think we were below 3% in the spring for some folks, for some highly qualified folks, but we got as high as 7%. I mean, what's been your read on all this?
Yeah, it's been a year. It's been an interesting year for interest rates and anybody in the mortgage world or buying a house. I think the uncertainty of what we entered 2022 thinking what it was going to look like. We knew there were going to be rate hikes. We didn't anticipate they were going to be that high, that quick. And that's what gives us hope going into 2023 for all the new buyers is we saw the Fed hike 4 significant hikes at 75 basis points. And that doesn't correlate directly to mortgages. It's not like if we raise 75 basis points, mortgages go up 75 basis points, but it is in correlation on the back end. So usually when Fed hikes rates, we respond from a mortgage rate perspective. So looking at that and having 4 of those back to back were pretty significant, and which meant if a buyer was shopping in June, and then all of a sudden come July, their qualification may look completely different. And that was tough. We are seeing that we're anticipating that we're out of that. The Fed is going to start to slow the hikes. We anticipate actually the one happening next week to be less than the previous 4, which is going in the right direction that we want it. The market has already absorbed the higher rates that we've seen. So we don't anticipate huge spikes. I mean, anything can happen, right? It's not guaranteed, but just based on the Fed hiking the rates and into 2023, we don't anticipate seeing the volatility that was happening in 2022, which should give home buyers entering in the market now a lot more warm and fuzzies.
Right. Yeah.
Yeah.
And for folks that are, kind of confused on that whole, well, the Fed is raising rates, but that doesn't exactly impact the mortgage rates, the exact same way. The reason is that the Fed funds rate is really, and Britt, correct me where I'm wrong, but the Fed funds rate is really how banks borrow from each other, right? And that's the rate that they're paying each
Correct.
other. And I think what I've
Yeah.
heard that's been really interesting lately, and it makes sense, is that there's typically a spread between that Fed funds rate and what you actually see on your mortgage rate. And that spread is more or less what the banks are kind of pulling in as profit. Now, I've seen that has gone up to like 2.3%, like 230 basis points versus an average of like 170 basis points in the past. And I've heard a lot that that's because of the volatility we've seen this year. And if that were to shrink back up, we would see rates actually come down, even a little bit more. So I don't know. We'll see what's to come. But yeah, there's been a lot of interest around those interest rates, and I think we're all hoping that inflation gets under control here. And that's one of those things that's I think people can they don't have to understand it all, but just again, get that team of advisors around them to help them understand like what's happening, and does it have any negative or positive impacts on my buying process.
Yeah, I think that's a great outlook. And, one of the biggest sayings that's going around right now is you marry the house, you date the rate. And at first it was kind of, everybody kind of chuckled at it, but there's some truth behind it, right? When you were looking at a house, even just at the beginning of the year, you were potentially offering, depending on the house and where it's at, right? You're offering maybe 20, 30. I've seen people offer over $100,000 over asking. And first time home buyers that didn't necessarily have that to work with, yeah, the rates were great, but the availability of purchasing a home was very slim. Now we're seeing that option of first time home buyers coming in. Homes are on sale. They're actually able to make an offer and get it accepted. Sometimes you can get seller concession and help pay your closing costs. There's all kinds of really cool things that you can do as we slowly creep back to that balanced market, like you referenced on the other slide, of having more than just a few weeks of inventory available. And so what's happening is, let's say that you purchase a home in this market and your goal is to be in the home 3 to 5 years. Within that 3 to 5 years, we want to look at, or longer, right? You could stay in it for 30 years, but within that 3 to 5 years, the appreciation, the recoup of the market is going to hopefully positively impact your home value through appreciation, which we'll get to on a different slide. But in that time frame, the chances of you doing what's called a refinance is actually pretty great. So what that means is, if you purchase a home today, and let's say that your rate is, like the slide references, 6.49, okay, and rates, let's say by the end of 2023 are at 4.5. You can do what's called a refinance, where you can come to me and say, hey, I want to take this loan that I have at 6.49 and I want to pay it off with a new loan that's at 4.5, for example. You can do that and take advantage of the lower interest rate. So now let's fast forward a year and you've still got the home that you bought on sale, with negotiation from the seller, and now your rate is at a lower rate than what you bought it for. Do all markets accommodate for this? No, the one that we just went through didn't, because most of those buyers had interest rates in the 2s and 3s. But what we're coming off of is people who have locked or closed at 7 or 7.5 potentially within the past few months. If we drop back into the 5s by mid 2023, hopefully, they're going to probably start to want to refinance. And so we hope to see that cycle through. The average of that is about 18 to 24 months. Clients will refinance for one reason or another. So when we go back to, hey, you marry the house, you date the rate, it's true. You're more than likely going to keep the house for a longer period of time than you are the rate. So in markets like this, where it is becoming a buyer's market in some sense, it's a better deal sometimes to purchase the house now, knowing what your long-term, short-term plan is for your mortgage.
Yeah, absolutely. And I think, speaking directly to that, this actually shows for the Denver metro area, really the appreciation that we have seen on a yearly basis since 1992. And there's a few things to note here. First is, what's the average annual appreciation? Well, it's just a hair under 7%. Nationally, I know that's a bit lower. I think it's closer to 5 to 5.5%. But here in Denver, again, a very strong market, really since the 90s. And when Britt talks about that opportunity to buy now, this is the big reason for that, right? Is you want to be able to take advantage of and really I guess get the benefit of that appreciation that you're seeing on the screen here. And just again, to speak to the strength of this market, a lot of people look back at one of the worst financial crises that ever occurred, and it actually started within housing, and that was in 2008, right, with the crash there. And you can see that the Denver metro area, while it did lose some ground there, for being one of the worst kind of crashes out there, to only have lost 4.7% in 2008, I think speaks volumes to the strength of the housing market here. Of course, past performance, as they say, never predicts future performance. Nobody here has that crystal ball, as I said, but if you can buy now and take advantage of that appreciation, and hopefully be able to refinance later in the future, it's definitely a smart thing to do there. And Britt, I think later on you're going to be speaking to some of the different types of loans you can do. Are you going to be speaking about like 2-1 buy downs and that type of thing?
I'm not going to go into the 2-1 buy downs on this one, but that would be a great thought. We can touch on that slightly to maybe spark curiosity to have that deeper conversation from just a mortgage review that we'll chat about too.
Yeah, that makes sense. We want to talk about it all, right? But there's just not enough time. Well, yeah, I mean, there's tons of benefits to home ownership. And Britt, I know you can speak to a lot of what's on this slide. Do you want to take it away?
Yeah, you bet. So the first one, I actually think the last one listed on the slide is the most important, is the emotional impact of owning a home. I think that pride of being able to paint your walls whatever color you want and nail pictures to the walls, right? Things that you can't do when you're renting a place. I think that is probably the most important. But the others are right under it. You've got principal reduction as you pay down your mortgage, and I like to kind of use this. Most clients have a car loan, and so when you think about it, you're making 60 payments on a car loan for 5 years, for example, and your payment is being dispersed each month that you make that payment, some to principal, some to interest. The mortgage is structured like that as well, just on a bigger scale. So when you're going to pay $2,000 a month for rent, that whole $2,000 is going to your landlord, as to where when you pay $2,000 towards your mortgage, a big portion of that, or I shouldn't say a big portion, but a portion of that is going towards your principal reduction. And once you have that and you start to see that rolling pay down on your mortgage, every month you get a statement and you go, hey, now we've paid down $1,000 over a mortgage. That feels so great. It's kind of like a savings account that you don't see, right? You're paying that mortgage down, all the while that appreciation you referenced is happening, hopefully, as well. So as your home is appreciating and the mortgage is going down, you're gaining from both sides, which is where that benefit really comes in. Potential tax benefits. So depending on your tax situation, a lot of clients can tax deduct their property taxes as well as their mortgage interest that they pay. So that can sometimes provide an end of year savings and some reimbursement back on their tax returns, depending on what that looks like for each client. We talked a little bit about the appreciation. And then utilizing your potential equity for home improvements. So if you have, let's say you have a big savings account, let's say that you have $50,000 and you want to put that down on a home, but you think, gosh, what if I want to do projects to the home? If you put it down on a home and you wait a year or 2 years to do those, by the time your home has hopefully appreciated and you've paid down, you could potentially still get that equity out down the road and do those home equity improvements if you wanted to. So the money is still there in some capacity, usually through either a cash out refinance or even through a home equity line of credit. A lot of times they'll give you access to your funds depending on how much equity you have in the property. So that's always something you can look at to regain access to those funds if you want to put them back into the home.
Yeah, now, these are great. Now, as far as the pros and cons, walk us through this, Britt.
Yeah, so the property types, the way I kind of like to explain it is it depends on what you want. And this is where when they do their buyer's consult with you, or we have an initial conversation for a pre-approval, I'm asking these questions of saying, what are you looking for? Are you looking for, a 2-bed, 1-bath condo? You like that apartment style living because you have amenities, you have a swimming pool, you have a gym, all of these things. Or are you like, hey, I'm so done with sharing a wall with somebody. I want my own space. I want to
Mm.
plant a garden, and we're trying to find which category you fit in on if you're shopping in a condo category, which is going to be more like apartment living, right? Or a single family home, which is going to be more bigger style. You've got more maintenance. You've got more control. You have a little bit of maintenance, but you also have the ability to own the property. And I mean, you own all the properties, but you're owning the property and a little bit of the land, as well as being able to do with that piece what you want. So the townhome is kind of a blend depending on what you're looking for. And those come with pros and cons. For example, the single family, a homeowners association is something that is put together, and you could probably speak more to this, Jacob, but is put together depending on what the covenant is going to provide to the homeowners. So if it's trash, recycling, most of the time, for instance, a single family home that I live in, they provide trash and recycling. We do our own snow removal. They don't mow for us. They don't do anything like that. So the cost for that is pretty minimal. It's like $25 a month. It's very traditional, $25 to $100 a month, probably for a single family home. As to where a townhome is going to be a mixture of that. You may not have a swimming pool, you may not have a gym, but you may have snow removal. They may cover the roof of the property or something like that. So that may be a $200 to $250 HOA. Some condos, you may have all the perks, right? Especially if you're getting into the downtown area and you've got a gym and a workout room, or a pool, or you've got a common area with coffee or whatever. Those can get upwards of $300-400 a month. So when we're looking at this, it's nice to get specific and look at these pros and cons on each property type as you're starting a first-time home buyer, starting to figure out which property type fits your needs the best.
Yeah, absolutely. Yeah, and the HOAs, they what's great about that is you get some of those details in the listing, and so when we're looking at those, we can give you some of the highlights of those, and then before you ever make a purchase, you're allowed to it's required that you are able to look through the documents, the HOA documents, make sure there's nothing in there that you just can't live with. And if there is, you're actually allowed to terminate based on that. So yeah, there's Colorado is a very buyer-friendly state when it comes to contracts, and there's lots of opportunities for people to review things, make sure that they're comfortable with it, and if they're not, they can terminate, and if they're good with it, they get to move forward. So yeah, no, really good points on just the different property types there. Now, credit scores, I think everyone has a love-hate relationship with these things, right? And
Yeah.
everyone's always trying to figure out, like, how is this actually figured out? It looks like you've got a nice little graph to help us understand this better.
Yeah. So, I think one of the biggest things is a lot of people think that they're kind of shocked by how much weight the payment history controls your credit score, but really that is the number one component. 35% of your score is if you make your payments on time. And not to say that that's the easiest one, but if you are focusing on it and have the ability to make the payments on time, it's going to impact your score more significantly than anything else. The second one right behind it is the amount of debt that you owe. And this is one that also I think kind of shocks clients because they're like, well, I only have a $500 credit card. But if you owe $400 on that $500 credit card, what they look at is your ratio, right? If you owe 400 against 500, you're at a really high ratio. You're above a 50%, what they call revolving ratio. So the goal would be, if you take that same client, let's say they had a $10,000 credit card with a $3,000 balance, right? You think, well, 3,000 on a credit card versus 400 seems more, but the revolving availability there, you're only utilizing 30% of your line. And so that goes to show your ability to not maximize or max out all of the credit that has been extended to you. And so it shows more financial responsibility. So depending on how you're setting up your credit and what education you have behind it, sometimes what starts as good intention can actually negatively impact. So it's good to know these top two because they do carry 65% of the weight of your credit score. The length of credit history is always a big one too. Clients think when they pay off credit cards that they need to just close the card. And if you've had that card since you were 18 and you're 30, you just closed out a 12-year card. Now, if you have the ability, there's a difference, right? If you're going through a debt consolidation, you need to close these cards because you're afraid that you'll go back into debt. I understand that piece completely. But if it's just a technicality of, hey, I'm paying it off, I'm not going to use it, I have my new rewards card over here, leave it open, because having that availability and not using it is better than closing it and taking away that long-term history.
Yeah. Yeah. And Britt, I mean, when people come in and look at some of these things, I mean, one of the things that you mentioned there, as far as like using $400 on a $500 limit versus, and that being worse than having $3,000 of debt. Some of these things are counterintuitive. Are these
Right.
things that you advise clients on?
Yeah, so it depends, every person is different, and there's no two credit reports that are ever the same. And so we have something called a credit score simulator, which is super neat. So when clients apply with us, let's say that you're at a 698 and we want to boost you to a 700. I can put your credit in this credit score simulator and it can say, hey, if you pay this credit card off from $400 down to 200, we're estimating that it's going to boost your score to 705. And that may be the difference in your interest rate, because interest rates are driven by credit score specifically, the lower of the middle score. So if there's two borrowers, whoever has the lowest set of scores will take the middle of that one. If it's one borrower, we're going to take straight down the middle. So you could have a 680, a 700, and a 720. In this case, we'd be taking the 700 to generate what your rate would be. So if you're 2 points off from the next tier of rate, it may be worth it. So we take an in-depth look depending on what your credit history looks like, especially if you're needing to do credit. Maybe you come and you've got a 540 and you're wanting to boost up to a 620 and do an FHA loan. We can help you get there in most cases, or we have, referral sources that we can have help you with that. But it's more than just an order taking with us. It's very much in-depth and education piece.
Yeah, absolutely.
Yeah.
And I think that's a great segue into building your team of advisors. Again, I mentioned this earlier. I think a lot of folks think that, well, I just go to Zillow and find some houses, click a button, and I'm off to the races. And while that's certainly a way, we like to really help people understand a better way. Again, we take a very modern approach to all this. And the reason that we do that is we want people to have a great experience in buying a home, because real estate is very important. All of us here are very passionate about this. We love helping people find that next home because it is their home, right? It's something very special and important to them. But it is such a large investment that you want to do it the right way. And the way you get started on any of this, and whether you want to have a conversation with myself and Britt or anybody else, just please go about it in this way. And that's find yourself a team of advisors, and not just people that are order takers, not just people that are, not giving you want people that are going to challenge you, honestly. You want people that can answer questions and that will challenge your thinking a bit, so that you've got all the information. If you're just dealing with order takers or, kind of people that are just, willing to say yes just to get you to move forward, that's just not in your best interest. And so finding folks that are there to be your advocates, I think is super important. And, I know for Britt and I, we look at this as, we're here to be a fiduciary for you. And what that means is we're here to look out for your best interests. And that's to make sure that if we see something that's, just going to negatively impact you in some way or another, it's our responsibility to tell you that. And if you still want to move forward, that's your choice. As we always say here at 8Z, we're here to make sure that we give you lots of confidence, lots of control, and lots of clarity, the 3 C's here. And if we give you that clarity, it gives you the control over the decisions. And that is the most important thing here, is that you're dealing with folks that can get you that information, get you lots of clarity on things so that you can make the decisions for yourself, but know that there's a lot of support and confidence, behind that.
Mm-hmm.
Britt, anything else you'd want to say on as far as building a team?
No, I think you hit all the points. I mean, you're absolutely right. When you find that the top two, your realtor and lender, I think everything underneath that, if you find the right advisors, they have done the due diligence on the back end. I know for you, Jacob, running in making sure that you have the best inspectors lined up for your clients, making sure that you have the best contractors lined up for your client. And so it reiterates that one-stop shop of a team, and knowing that if you find one advisor, you actually find all of those advisors in one spot with 8Z.
Yeah, totally agree. And I think what's important too is you're not locked into to using any of these folks, but it is, like you said, it's so nice knowing that, someone has already vetted a lot of this for you and can speak to, the quality of somebody's knowledge, and the process that they provide and all that. So again, just a super important first step in any home buying journey. So from there, we get into financing, and we are lucky enough to have the expert with Britt here. So Britt, why don't you walk us through, what should we be thinking about when it comes to financing a home?
You bet. I mean, I think these two slides, the biggest takeaway I want everyone to have is that there are options, right? Everybody assumes if you don't have 20% down, you can't buy a home. If you don't have a 780 or 800 credit score, you can't buy a home. You're not going to get a good rate. And a lot of those myths were created years and years ago when maybe that was the case. But since then, the market has opened up so many different options. The first one we're going to start with, conventional. I won't touch all the bullet points, but just to give you an overview, conventional is the mainstream. It's the conforming loan. It is the most streamlined mainstream loan option that's out there. So if you hear somebody talking about a 20% down, mortgage, they're probably going to be talking about a conventional loan. And that is more tailored to clients who are at or above, ideally a 720. And I say that not because they can't get it if they're under that, but most of the time, if you're putting less than 20% down and you have above a 7 or 720, you're going to get better pricing, better mortgage insurance options, just more competitiveness in this product. Now, if you're under, let's say that you're under that, you're maybe at a 620 and you're like, hey, I want to buy a home. We still have options for that. That's where we move over to FHA. FHA is a government-backed product that says, we don't care if you're a first-time home buyer or a repeat home buyer. We have options as low as 3.5% down. And I forgot to touch, the conventional loan has an option as low as 3% down for first-time home buyers too. So if you're in that higher credit score tier and can qualify for conventional and you're a first-time home buyer, that 3% down option is great. If you're not, right next door is FHA with 3.5% down. It allows more flexibility with debt to income. It allows more flexibility with credit score. So if you don't fit in the conventional box, FHA is an amazing option. They have competitive interest rates. Mortgage insurance is something that if you don't put 20% down on a loan, you will have if you're with conventional. It's just a risk-based product that we can also shop like we would a rate to try to get you the best mortgage insurance rate as well. FHA, on the other hand, they set their mortgage insurance, which is kind of cool because if you've got a 620, they're not going to give you a different mortgage insurance rate if you had an 800. Everybody's created equal on that playing field with FHA. So there's a lot of pros to that. Sometimes what we'll do is we'll have clients that start out in an FHA, and once they build that appreciation and pay down some of their loan and boost their credit score, within 18 to 24 months, they're refinancing into a conventional, and with some more pros and lower monthly payments, hopefully, is the goal. So those two are the most mainstream that you'll see. If you want to click to the next slide, the third one that we have is one of my favorites, and it's the VA loan. If you have served in the armed forces or part of the National Guard, or you are a vet that has a certificate of eligibility where you have the ability to use the VA program for a VA loan, it's amazing. So you can put as little as 0% down. zero down, and there's no mortgage insurance, even if you put zero down. Their rates are incredibly competitive. Their product is fantastic. Their guidelines are really flexible for vets, and it's just a product that's near and dear to me. Christy, my assistant, is a vet. She was a air traffic controller, so she has that background in history, so that's always been near and dear to our hearts. But that's one of the best. If you qualify for a VA, that's definitely a great product to think about. And then we have a couple of down payment assistance programs. So tied into all of those other three, the first, the FHA, and the conventional, there are some first-time homebuyer products that will allow that 3% down, that will allow a discount on your rate. Those are usually very specific to the borrower that we can chat about, one-on-one. But usually what I get asked about second to first-time homebuyer programs is going to be down payment assistance programs. And that's where CHFA comes in. CHFA stands for acronym for Colorado Housing Finance Authority. And what they do is they let you choose if you want to do conventional or FHA or sometimes USDA. And if you choose one of these products, then they will couple it with either a grant program or what they call a silent second, which pretty much means you can borrow your down payment and not have to pay interest on it as long as you keep the first loan in place. And so a lot of times what that results in is clients being able to get into a home for worst case, maybe $10,000. Best case, sometimes as low as $1,000 if you can, maybe work with the seller and get some concessions on their closing cost. And so CHFA is a great program. I've actually done quite a bit of CHFA over the years, and their program continues to be very consistent and very helpful to clients who think, oh my gosh, I need, at least 20 grand or 25 grand to get into a home. And then all of a sudden you get somebody in with $2,000 and it feels really good. So that's definitely an option.
Yeah.
And then you have jumbo. Jumbo is going to be more for the high dollar loans. If you're purchasing a home, closer to the $900 million and you've got 20% down, you may be just outside the conforming limits. This year for 2023, they're $726,400. Why they don't make them round numbers for my sanity, I'm not sure. But if you're outside of that, if you're going to buy a $950,000 home and you're going to put 20% down, your loan amount's probably going to be around $760,000. And for the metro area, that's going to be outside of that conforming limit. So we may look at something like this that are usually private bank owned, but super competitive with rates as well on our programs and what we have to offer.
I think this speaks back to something we covered earlier, right? Where you can kind of go shopping for your clients and really find what is that best product for them, and not just saying, well, this is what we have available, so take it or leave it, right? Absolutely. Great. So everyone keeps hearing us say, like, you got to get pre-approved first, right? That's one of the first steps after you've kind of built your team, get pre-approved. So Britt, tell us more about, like, what does that mean to be pre-approved? What's required? What should someone expect there?
Yeah. So when you go to write an offer, usually the listing agent is going to ask, hey, have you been pre-approved? And that's a way to say, has somebody looked at your credit, your income, to say that you could afford this home that you're writing an offer on? And so one of the things I like to do, which is kind of the pre-step to this pre-approval process, is before you do the application is have that initial consult call. And this can be a year out from when you're ready to buy. It can be 6 months out. There's no requirement on how soon we can chat, but I find that the sooner that clients do it, the more comfortable they feel, because we're having this conversation over the phone. And before somebody completes an online application, even myself, when I was doing my own mortgage, I got a little nervous. It's just that anxious of like, oh gosh, am I going to be approved? And so when you have that initial conversation, my goal is always to ask what the goals are. What is your payment goal? How much money do you have to spend? Where's it going to come from? Really, what are you looking for? Condo, townhome, single family home? And then kind of digging into, okay, what do you make? What are your debts? And if they're comfortable sharing, usually that initial conversation, I think we're going to be able to get you in the range of what you're hoping for. Why don't you go ahead and fill out the application so we can get it fine-tuned? So that provides a little more confidence. They go online, they do the application, and they provide their documentation, at which point I circle back and say, hey, great news. When we chatted the other day and I had estimated your pre-approval at 400, we're actually going to be able to get you up at 450. And that gives them a specific amount that they can shop for. So if you're wanting to shop for homes at 425, it's nice to have a 450 pre-approval because you have a little bit of wiggle room in case that perfect home pops up at 427.5, it's always just right above where you want to be. And that way you have this wiggle room and you feel confident and you can write that offer. And so at that point, the pre-approval is provided and they get to go shop. My support process and what I think sets 8Z Mortgage apart from other brokerages is our commitment to connect with the client through every home that they find that they would want to write an offer on. I truly believe that when a client is walking into a home, if they're going to walk into the home and see it with an agent, and you're taking them to that house, they should know what the payment's going to be. They should know what their cash to close is going to be. They should have a realistic estimate in their hand because nobody wants to go to write an offer and find out that the taxes are extremely high and the payments out of their range after they've walked in and seen it. So that's the piece where I will just follow up or have the clients follow up with me, or maybe you'll send me a property and say, hey, we're going to go see these 3 properties this weekend. Can you run me some estimates on those? And so that's what's happening after the pre-approval process until the next slide, which is actually what happens once you go under contract with a client. And so these options, once you've started, most of the work happens within the first 10 days you go under contract. And I'll preface this by saying the biggest piece of doing that initial pre-approval at least a week before you start shopping is so that your mind has time to wrap around the mortgage side. You get to get that out of the way so that when you start this process, you're not doing all the back work at the same time, especially if you're a first-time home buyer. I really love to take it step by step, and I know you do too, Jacob, because it's very much education, support, that confidence, that clarity that you talked about, that happens with time. So giving you time to process each section of the process is so important. So if we have the first conversation on a Monday and you get the documents and we get the pre-approval out, then by the time the weekend comes, you've had time to process all of that and get all of that flowing. And then if your contract gets accepted, which we hope it does, that's where this part kicks in. So you get a contract that's received on let's say it's a Monday night. Most of the time when you write contracts, you'll have a deadline for an acceptance on Monday. It's Monday night. Jacob calls with the good news. Tuesday morning, I'll be your gal. You'll want to call and chat with me and say, oh my gosh, I'm under contract. What do I do? And that's where we're going to walk through all the final numbers. What was the purchase price that was accepted? Let's lock your interest rate in. Let's go over any additional documents that you need. Those are 4 steps that are going to happen within 24 hours. Once you have the list and you're working on your documents, Jacob's going to help you set up a home inspection. We're going to have you pay for the appraisal if one is needed, and we're actually going to take care of that for you. You don't even have to set that up. And then your loan's approved. We get your loan approval. We let you know if there's any other documentation waiting, and then we submit you for clear to close, which means, hey, the hardest part's done. Once you're clear to close, you're waiting on that bottom line figure, which hopefully is under what you had originally thought it was going to be. And then we're off to closing day. So once you break it down into those 2 steps, you have the pre-approval process and your intro chat, and you kind of do the loan side. And then you get to really just focus on the purchase and preparing for your moving day.
Yeah, absolutely. And one of the important outcomes of that pre-approval process is not just seeing what you are approved for, but actually getting a pre-approval letter. And when we make an offer to a seller, they actually want that letter, right? They want to make sure that they're dealing with someone who's serious, who's qualified, who can actually purchase their home. And so that is really a kind of an unwritten requirement these days when you're writing an offer. And so it's important to have that. And then as Britt said, as you go through the process, what's great about having a great team of advisors around you is there's a million details that do have to be taken care of. Unfortunately, that can be overwhelming for people that don't have a good team in their corner. A good team is going to bring a lot of organization to those millions of details and deadlines and all that, to ensure that each step is given the proper amount of attention, and that you're able to, again, have that clarity you need to make the right decisions on time every time. So yeah, there's so much to cover on this, and I know we're running out of time on this webinar, but that's why a consultation with myself and with Britt just allows us to cover so much more in your own situation.
Yeah.
And Britt, I feel like we've covered we've kind of danced around a lot of the pitfalls that are out there. Maybe since we
Yeah.
are running out of time, we'll just kind of go through these really quickly. But not being prepared for the process. Again, people that are just jumping straight into Zillow and starting to click buttons and thinking that they should just go start touring homes. Again, while that is a way of doing it, there's just so much better of a way. So that, I mean, what if you're walking through houses that are out of your budget? What if it's below your budget and you could actually be looking in a different price range? There's just so much there that you may not know. And so being unprepared for that process can be a real problem. We've already talked about building a team quite a bit here. Not knowing your credit, I know some people it's just not something they even want to think about, whether it's good, bad, or whatever, because it's just confusing. But it's seriously important to know this stuff. And again, connecting with someone like Britt can be such a huge advantage for you, not only on the credit, but like we said, on knowing your budget, knowing what's going to be required, going into closings, all of that. At the height of the market, people were doing things like waiving inspections, things like that. I will never, ever advise a client to skip an inspection. If they don't want to have something fixed, that's another thing. That's a known decision that they're making, but don't ever skip the inspection. You've got to at least know what you're dealing with, and be able to make a decision based on that. Anytime you're guessing, you're doing it wrong when it comes to to buying a home. Britt, what are your thoughts on, you mentioned like putting a down payment down, and people wanting to keep a reserve for unexpected, repairs, things like that. I mean, is there kind of a reserve that you kind of tell people to keep back when they're thinking about their down payment?
Yeah, I mean, I would say 2 to 3 months of your mortgage payment is a good rule of thumb. And that's just for anything that's unseen. It's the joys of homeownership, right? Things can come up at any time. But yeah, I would say that would be a good goal. And we usually talk about that when we have that initial consult. If somebody says, "Hey, I have $30,000 and maybe the 3% down is only 25,000, then we have that chat. They're going to have 5,000 left over, because I think that's really important for them to know, hey, if you're going to use this, it's going to deplete all of your assets, or, kind of show me the big picture. Tell me everything you have so that we make sure and try not to deplenish all of your reserves or financial securities there in case something does pop up."
Yeah. Yeah, and the last one we have on here, again, this is not an exhaustive list, but these are definitely ones you want to keep in mind for now. Waiting too long, and that doesn't even necessarily mean waiting too long to buy. I actually consider this waiting too long to meet with a team of experts that can advise you on this, right? Because if you go and meet with somebody tomorrow about your goal to buy a home, you're going to have one of two things happen for you. Either A, you'll have a plan to get going right away and you're off to the races, right? But let's say that you are not ready, that you meet with those advisors and they tell you, you know what, you're not quite ready, but here's the path towards that. Well, then that's the second scenario. And now you at least know what you need to do. You can take steps towards that. And you have like I said, an actual defined path to walk now. Waiting too long to actually speak with people that can actually act as your advocates and give you, in some cases, the hard truth, but hopefully in most cases, the exciting kind of process to all this. There's just, you can't replace the benefit and the value of that kind of advice from folks that know what they're doing, do this every day with clients like you. Britt, any other things that you would add to that point, or any other pitfalls?
Yeah, I love that. Just to second what you said, a lot of times I'll see clients who they weren't anticipating actually that they needed to buy a home. Maybe the landlord is going to sell the property, or the landlord's moving back and they're not going to let them renew the lease, and all of a sudden they have to move very quickly. By the time we have that conversation, their credit score may not be up to date, or maybe they do need to save a little bit more, right? Had we had that conversation 6 months earlier, we could have at least had them on a path for preparation. So just because you have the conversation doesn't mean you have to jump into the market immediately. It's more about that education and preparation for when you are ready, you have a plan in place so that you can actually buy and be in scenario number one when you chat with a loan officer or an agent. and they get to say, hey, let's start shopping now, instead of having fear behind it.
Yep. Well said. All right. So, we talked about some pitfalls there. You've got some do's and don'ts here with the loan process. Britt, do you want to walk us through these?
Yeah. So the do's, make sure, we kind of talked about this in the credit scenario. Make sure you make all your monthly payments on time. Simple as that. Get pre-approved, have that pre-conversation with myself or a lender that you trust. Make sure that you know what your realm is, what your plan is, what your savings plan, what your credit score plan is to get yourself in preparation for buying. Save as much money as you can. This one is unique because I feel like a lot of times clients want to pay off all their debt, and they don't have any down payment, but they have a really high credit score. I would almost rather you have, instead of having a 780 credit score and no debt, I'd rather you have a 740 and money to put down on a house. So that's where that advisement is. If you start to kind of take this into your own hands and think, oh, I'm going to take my savings and pay off all my debt, that could push you back 3 to 6 months. So having that upfront conversation is key to that advisement piece there. So save as much money as you can, even if it means making your minimum payments on all your debts, obviously on time, but just, making those minimum payments and saving as much as you can. And then last, taking into account your current spending levels in your budget. Having a budget is huge, and connecting with a lender that says, hey, you can be pre-approved for $600,000 and here's what an estimated payment of that would look like. You're going to be able to go back and put that in your budget and go, okay, this is doable, and really break down what you feel like you can afford instead of being lopsided on your monthly budget. We want you to be prepared for that.
Yeah.
The don'ts, don't make any significant career moves or changes in structure. And what this means, if you're going from a software engineer salaried to a self-employed professional bowler, we're probably going to need to have a chat. Okay. So anytime you're making large career moves where you're going out of one industry and into the other, or changing the way that you're paid, specifically from being self-employed or specifically from being W-2'd, working for a company, to being self-employed, before you make that change, chat with a lender if you're wanting to buy within the next 6 to 12 months, because a lot of times if you're making that change, you've got to have 24 months of history of self-employment, and it could prolong your home buying experience. Don't make big purchases. That can directly impact your qualification. So if you go out and buy a motorcycle or a boat or a second vehicle with a very large payment, it can seem innocent at the time, and you may be able to carry the debt, but the monthly payment may impact what you can qualify for. So that's also something you can call and, kind of give us estimates, and we can tell you how much you could afford if you do need to buy a second vehicle or such. No large deposits into your accounts. This is kind of a big one. I actually had this happen. I had a guy deposit $5,800 for a rare Pokemon card that he sold on eBay, and there was no record of tracing the funds. And when you buy a mortgage, we have to know where the funds came from. And so that was kind of a pitfall that could have been avoided. And so we always just want to know, if you get $1,000 check from grandma, call and let us know, and we can advise you on how to do that. It's always about getting ahead of it instead of trying to fix it after the fact. And then we already talked about this one: close old credit cards, or pay off collections. Don't do any of that. Sometimes actually paying off collections can impact your score in a negative way. And closing the credit cards can do the same thing as well. So that's where that credit score simulator that we have access to is going to be incredibly beneficial to say, okay, do this, but don't do that. So you utilize us for that advisement too.
Yeah. I mean, I wish we could do that with everything in life, right? Like run it through the simulator and just see, okay, what should I do about this?
Yeah. It's like a crystal ball kind of.
Yeah. So we've talked about a lot here. We won't go through every line here because we've really covered this throughout the webinar. But I mean, it is so important. If you don't learn anything else from this webinar, just remember this: please connect with the right people. Right? Get yourself someone that you trust, someone that you're either you've got someone that's referring you to someone that is just of high integrity, high expertise, high competence, all that. I mean, the internet is a powerful thing these days, right? You can look at reviews and all that. And I think that's important as well. But really just finding someone that's got a great process, has access to other great experts within this field. All that's very important. And like I said, I think it's the most important part of all this, because if you get the right people around you, specifically the realtor and the lender, everything else will fall into place. You get the right people in those seats, I promise you, everything else will fall into place. Britt, anything else on that you want to add?
No, I second everything you said. Yeah, absolutely. If you start high with your advisors from the top, everything else will fall into place.
Yeah, absolutely. So what would be the next steps from here? Well, that you can go in any order you like. I like to start with Britt because the finances really do dictate quite a bit when it comes to buying a home, and so it's great to reach out to her. But if you do have questions, you want to run through a buyer's consultation first, we can do this in any order that you like. But if you've liked what you've heard here, you want to learn more, I promise you there's a whole lot more to discuss in your situation. Everything it's a very personal journey that you're taking, right, in buying a home. And it's not just around your budget and all that. We've got to dig into, like, what are your goals, what are your timelines, what are some of those needs that you have. Well, we need 3 bedrooms, and we need that office because we've got to have time for the Zoom calls like this, right? So or space for the Zoom calls. So the next steps are to get in touch with us. Just let us know what you're thinking. We can have a very non-obligational, very easy conversation over the phone and just get things started that way. And if you like the way things are looking, Britt's got a way of having you fill out an application really online, and all that is super simple to get started. On my side, we can start with a call, but ultimately I love getting people into the office and just walking them through a buyer's consultation, which is really just teaching them more about what does this whole journey look, what does it all look like? What is, what are some of the next steps that we have to take, and actually starting to develop a very personalized home search to get things started. So with that, thank you so much everyone for joining us here. Britt, thank you. Let me hand it over to you for any last thoughts.
No, I concur. I mean, I think setting up these initial consults and just knowing where you're at and getting a time frame, whatever your time frame looks like, whether it's 3 months or 12 months out, just having a little bit of knowledge behind what to do for when you're ready can make all the difference. So thank you so much for having me. I hope this was helpful, and I'm always happy to just have a phone conversation before you do an application or anything like that. That advisement piece and education piece is something I hold near and dear. So always happy to help.
Cool. All right. Well, thanks again, Britt. Thanks everybody. And we hope to talk to you soon.